Yes, sir.
All right, folks. Today was kind of an interesting day. We had opportunity, but not as much opportunity as I would have liked. So I just want to explain to you the rationale behind the actions that I took today so you can understand. This is the live action trader session, and this is all about helping you understand a variety of things related to building your trading business, including consensus of signals across multiple time periods in your charts, as well as using your chart as the primary defining point of making any decision on your trades. So I want to start with the Qs. Overnight, we held a Qs call. So we had a June expiration Qs call, and we were behind on that call most of yesterday. We got a little bit of a pop to the upside this morning, right at the open, and that was good news. It allowed us to close out of the trade. I ended up closing out of the trade pretty early this morning, even though I usually say I'm looking for 10% or more. That doesn't mean to imply that I will only hold out for 10% and I'm not going to take action otherwise, because it's so important that you use your charts as your guide. And so what I saw this morning is, looking at my consensus of time periods where I've got a 3-minute, a 5-minute, and a 30-minute chart. On the Qs, what I saw was a movement, strong movement to the upside. So right out of the gate, we had a gap to the upside. That's an oops pattern. Now, the shorter time period oops patterns is not something I usually pay attention to, but I could also see on my 30-minute chart that we had an oops pattern. And an oops pattern, for those of you who may not be familiar with it, is the high of the closing bar, in this case from yesterday, compared to the low of the opening bar for today. And if there is a gap, that's that gap open referred to as an oops, what we find is that approximately 93% of the time the price is going to move back lower, and it will, what we refer to as, satisfy the oops. It'll close that gap. Well, now in hindsight, we can see that that's exactly what happened. So there were a couple of things. We had about a 6%, actually 6.4% return on our position this morning. I went ahead and closed it out because the charts were telling me that the 3-minute stochastics was up towards the top of the range on both modified and traditional stochastics. 5-minute stochastics was up on top of the range, definitely above 75% on the traditional stochastics, which is the 1433 setting, and it was starting to climb above the 75% line on the modified stochastics. Now, at that point in time, I don't honestly know whether we're going to continue to move higher or whether we're going to reverse and pull off of that gap open. But I was aware that we had an oops pattern here, and I was kind of vacillating what I wanted to do, because we have the oops pattern that formed this morning, which says we could likely trade back lower, which we ended up doing. But we also had an oops pattern from yesterday, from Wednesday into Thursday's open. Wednesday's close into Thursday's open, we had a pretty big oops. So we could have continued to trade higher. So here was the decision I made. Overall, when you're trading the ETFs, it is not uncommon for the Qs, SPY, IWM, DIA to kind of trade along in the same general directional bias. Now, they do tend to act a little bit independently, but overall there's a general directional bias to the upside. We also held a SPY call, a July expiration SPY call, and I decided to go ahead and take the Qs off, even though it was a 6.4% profit, slightly less than what we like to earn. But I took it off because of the chart. There were enough weighing factors on the shorter time periods, the 3-minute and the 5-minute, that were starting to suggest, maybe we want to think about just locking in our profit. I don't need the charts to give me a precision entry type appearance, meaning I would not have opened a new position based on what I saw in the charts, but directionally it was in a zone that would say, if I've got a profit, why don't I take my capital back, because I can always look for another trade. So that's why I decided to go ahead and do that, close the Qs. And so we ended up closing out of the Qs, It ended up, hang on just a second, ended up giving us a 6.4% profit, and I'm pretty happy with that overall. It gives us an opportunity to use that capital then and put it into something else. Now, because I also held a SPY call, I jumped over to the SPY chart, and I saw, not surprisingly, a reasonably similar pattern. So this is where I decided to kind of split the difference here. I saw where we could possibly continue to move higher, and that's because of the oops pattern that was a Wednesday to Thursday oops. So we could continue to move higher and satisfy that oops. I saw pretty early on that 3-minute and 5-minute stochastics were up towards the top of the range. 3-minute was actually starting to get into red AOs. You could see that. And so what I decided to do, instead of closing the position, I didn't want to actually close the position because we didn't have a profit in the position. Well, let me back up just a minute. We've taken multiple actions on this SPY trade. We originally opened it as a call diagonal spread. Then we bought to close the short leg and took a profit. Then we cost averaged the July long call, and we have an average cost of $5.25. And so what I saw was the price on the option was stalling at around $5 to $5 and a nickel. So technically, if we had closed the position, our two contracts, for let's say a 25-cent loss on that position, and netted it against the profit that we originally took from the short call that we bought to close, we would have been slightly positive. But there were a couple of weighing factors here. I didn't feel like I needed to take quick action on this position because it's a July expiration. But I did see the charts setting up to a point where I might consider wanting to reduce the amount of capital commitment I have in that trade, the amount of risk, because I have two contracts where normally I'm carrying one contract unless I've cost averaged it. So the action I decided to take was to sell to open so we hold the 286, the July 286 call. I decided to sell to open a July 290 call. And why did I do that? The main reason I did that was because if, in fact, the price started to retreat and move lower, I might have an opportunity to buy to close that July 290 call and take an additional profit on the entire management of this position. It would be the second profit we would have taken on this trade. The first one was buying to close the June 290 call, and then that was one contract, and then this would be buying to close the July 290 call. But by selling to open the 290 call, it gave me that opportunity, perhaps if we move lower, to buy to close and lock in a profit, and I still am left with the July 286 call that's long, and I still have that, but I would have accumulated more profits. But if we instead continue to move higher, what I would have held was a spread, and the spread was a 4-point spread, the difference between 286 and 290, and the 4-point spread had a cost basis of about $2.30. So what it meant is that if we continue to move higher, I had an opportunity for the spread to still be profitable. But I had reduced the risk on the trade by selling to open the 290 and presented myself with an opportunity, if in fact we move lower, to buy to close that call. So I didn't know what was going to happen at the time. I knew that it would be wise, in my opinion, to reduce the risk on the trade, set myself up to take a profit no matter which direction we potentially moved. And I was okay with buying to close the short if we moved lower because I've got until July expiration for the long. So what ended up happening is we ended up moving lower. And again, going back to the charts, when I saw the 3-minute and the 5-minute towards the bottom of the range, and the 30-minute was getting down, the traditional stochastics was getting down towards the bottom of the range, that implied to me that the next bigger move was probably going to be back to the upside. And so I went ahead and took the 290 call off and took a profit on that. So now we have taken 2 profits on 2 different short legs on this whole transaction, and we're right back to just holding the 2 contracts of the July 286 call, and we'll continue to manage. We've got plenty of time. We'll continue to manage the position, and at some point either close the 2 contracts that I hold for a loss that we would then net against any other prior profits that we've taken. And my objective would be to make sure that overall the position management results in overall profit. And if that's not possible, if the charts are telling me that it's not wise to hold anymore or take any additional action, then we'll close for an overall loss, and that's okay too. But right now, I've set myself up to potentially, if we do move higher, close the long legs, the 286, the 2 contracts, the 286 calls, or possibly if we move back to the top of the range and I'm still not able to close the long legs at even, or maybe for a small profit, maybe a small loss. But if I don't feel like I want to take action to close them based on the current price, then we may move high enough to set myself up to, again, sell to open another call against the position, which would reduce the overall risk and set me up to be able to take a profit again if we move back lower. So I wanted you to really understand the action that we took on both of those trades, because both of them reside entirely in a chart analysis, and they reside entirely on the consensus of signals with the 3-minute, the 5-minute, and the 30-minute, those being the primary charts that I'm paying attention to. So, you know, of course, there are other factors that we can weigh in on that, such as this morning we had a gap open and we had a big Bollinger Band snap, which would tell me that we could perhaps continue to move back lower. So that's the gist of what we did today. And in summary, basically, excluding this current SPY position, excluding the current state of this position, and excluding any profits that we've taken against this position, because I consider this all to be one actively managed position. So it's not factored into anything that I share with you in terms of closed and realized trades. We've, in the last 4 weeks, because today is officially four weeks, the first 4 weeks of tracking our ATM, our new ATM service, and alerting the ETFs, we have opened and closed 26 trades. We are 26 wins, 26 trades, and we're averaging about 23% return per position. And we're averaging about a day and a half in terms of hold time. So those are really solid numbers in my opinion. And I don't in any shape or form expect that going forward that 100% of our trades are going to be winners. But what we are seeing and what you are seeing and what I'm hoping to help you understand is that by paying attention to and learning what we refer to as the art of trading in regards to a consensus of signals, using multiple time periods, consensus of signals, you can dramatically increase the likelihood of a profitable trade. You will have some losing trades. Fortunately, we haven't had one yet in the first month of taking these trades and alerting them to you. But you can be very, very profitable, very successful if you pay attention to what we are teaching you about consensus of signals. And there will be days that consensus of signals may change in terms of the time frame. There will be days I may refer to a 1 minute if we're in a very, very slow moving market. There might be days where I refer to a 60-minute. And I almost always refer to a daily chart, and I just want to share that before I wrap up and see if there are any questions. What's very interesting about all of the ETFs, they pretty much all look the same, is that for several days, 6 days, 5 days, we had green AOs, which was implying that we were starting to build some momentum back to the upside. And we saw our traditional stochastics crossing over to the upside. It was when that was occurring that I was leaning more towards spreads to take advantage of movements, because there were two technical indicators, two of the three that you see here, that were implying that we might start heading back higher. But we have one of our very reliable technical indicators, which is a variation of the stochastics, that was continuing to say, no, you should stay short. So there were conflicts on the daily. So I was backing into 120-minute charts. I was backing into 60-minute charts, 30-minute charts, trying to get a consensus of signals. And when I felt fairly confident based on the consensus that I sensed a direction that we were moving based on all of those technicals, I was taking a trade. But because there were some conflicts in the longer time periods, I was leaning more towards spreads as opposed to just buying a call or buying a put. So you're going to continue to see, if you follow along with these ETF alerts, you're going to continue to see those types of variables. Sometimes it's going to be a spread, sometimes it'll be a vertical spread, sometimes it'll be a diagonal spread, and sometimes it'll just be straight buying a call or buying a put in order to take advantage of the movement. One last thing I do want to share here. Yesterday I said that DIA, I shared in the room here that there's a high probability that DIA was ready to move to the upside. And I don't, let's see, that's the daily. I want to go to the 30-minute. And I remember saying that I'm not taking the trade because I already have a Qs and a SPY trade that were long. So I decided not to take the trade, but I was pointing out, for the benefit of anyone who wanted to follow along with that, that just based on what we were seeing on the charts, there was a high probability that we were going to move back to the upside. I'm not exactly sure what time of day that was, but I remember that the charts were all setting up. I mean, it was a perfect trade, and that's exactly what we saw this morning. So if you took the DIA trade, when I said that it was set up and it would be a trade I'd be taking if I wasn't already committed, had more capital, had enough capital committed to the upside, and I didn't want to put more capital into that directional bias. But if you did take that trade, then you should have done pretty well this morning at the open. It was a nice pop-up to the upside. All right, Michael, any thoughts, any questions?
Yeah, Arizona's asking, did we send out the SPY buy to closed alert today? We did, Mark.
Yeah,
We sent out around 11 o'clock, I think it was, and we actually announced it in the room. It hit my phone at 11 a.m. And we actually announced it in the room before we did it. So you got two alerts there. So it went through. I don't know why if you didn't get it, but it was alerted. And I don't have any other questions, Mark.
Okay, well, I really appreciate you being here, and I'm just going to tell you folks, trading is, it's as much a business as it is anything else, but it's kind of exciting when you learn how to take advantage of all of the different potential opportunities out there and really zero in on something that works for you. And I sincerely hope that between what we do in the live trading room already with the AO entry exit signals, with the Able Trend signals, with our futures trading on NQ and a little bit on ES, I hope that this addition of the options trading, and particularly the alerts that we're doing on the ETFs, adds value to your trading business. One of the things that I really like about having options as part of my trading, in addition to futures, is, to me, futures is that trading activity that requires my full-on attention right now. But options trading is something where I can decide that I have some time to look at some charts. I'm going to do my best review of the charts, look for a consensus of signals, choose a position or two, put them on, and then I can actually set an automatic close on those positions and I don't have to be attentive. So I'm willing to spend some portion of every day in a very uh, laser focused approach to trading, and that's when I'm trading futures. And then when I don't want to do that anymore, or have other things that I need to do that might take me away from the charts, take me away from my computers, I will put on a couple of options trades. I also do not carry futures trades overnight. And there are some really nice opportunities if you see a good setup, especially on a 30-minute chart coming into the end of the day. You see a nice setup, and you could go long or you could go short. It's a high probability, based on what our experience is on the charts, that that setup that you saw may carry into the next day. And so you don't carry a futures trade overnight, but you can put an options trade on. And options trades, in my opinion, are not trades in this type of manner, in the type of trading that we're doing, that should be next day or 2 day out or very short-term expirations. I personally prefer 3 to 6 weeks out. That gives me plenty of time. Look at the SPY trade that we're managing right now. I've got 8 weeks to expiration on that. Will I be profitable on that trade overall? I don't know yet. And it really doesn't matter to me. What matters to me is that I'm taking action each time I see there's an opportunity. And as long as I do that, then I'm going to allow that position to go to its natural outcome. So far, in the first 4 weeks of alerting these trades on the ETFs, as I said, we've had 26 trades and 26 wins, and we're averaging 23%. The percentage will vary depending on whether we've had a really strong win on trades, or a weaker win on trades. But this consensus of signals is a very powerful thing for any trader to learn. So if you are in the live trading room on a weekly basis or a monthly basis, you're getting the full benefit, I hope, of Michael, and next week Aaron will be back, Aaron and I, talking about this and sharing this with you and helping you see it. You can apply it to your futures trading, you can apply it to your options trading.